Hello and welcome to another Daily Dose of Insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today is Friday, so we have Fundamentals Friday here at Container Exchange, where we sort of look at some interesting, more higher level topics as sort of food for thought for the weekend. Let me quickly share my screen to give you a little bit of guidance of what I'm talking about. So today I just basically like to talk about three charts. We released our June forecaster earlier this week, where we also talked about sort of the current uptick in rates and the drivers behind it, namely particularly the volume uptick in an environment of restricted capacity. And we discussed at length that likely this volume uptick is not driven by fundamentally strong underlying demand, but rather sort of a pulling forward of orders of shipments driven by fear, sentiment, etc., etc. So I highly recommend sort of reading this June forecast. I'll also put a link in the comments. What I want to highlight here really is very, very quickly. On the left-hand side, you see US container import volume in TEUs, very, very strong this year. This is the light blue line, almost like unexpectedly strong. Pulling forward of peak season is sort of what's making the round in the industry, most likely driven by importers being scared that they don't get capacity or rates might go higher. So pretty much only sentiment driven. The result of that is, and that's the middle chart, the spot rates jump very, very sharply over the past 4 weeks on really both trades, North Asia to US East Coast as well as North Asia to US West Coast. Rates now surpass the rates that we've seen beginning of this year in relationship or in conjunction with the crisis in the Red Sea. So of course the question is, how much further will rates increase? And then the last one is, I think, very, very interesting. This is the NVO allocations on vessels. So carriers always have a choice what kind of business to prioritize on their vessels. Is it a direct shipper business, so with the BCO, the beneficial cargo owner, or is it with the NVOCC, the non-vessel operating container carrier, who essentially just rents space on the mainline vessels? And what you see here is that as spot rates spike, carriers do prioritize direct carrier business. Of course, here cozying up, so to speak, to the end customer. This is also very much in line with some of the strategies we've seen over the past years, with carriers trying to capture more of the value chain, sort of dig deeper into end customer relationships. And of course, now with rates soaring, that's a great opportunity for carriers to capitalize on that and prioritize those BCO or shipper relationships. So all of that, of course, is very, very connected. I thought just putting this out here, and again, highly recommend reading our June forecaster. I'll put a link in the comments. Now, thanks a lot for tuning in. Have a fantastic start into the weekend, and yeah, see you all on Monday, I hope. Take care.